back to the Real Estate Minute, where I answer your questions, talk about what's happening in the real estate industry, and give you the latest money and real estate news. You can find the latest episodes here on my YouTube channel. It's called Expert Real Estate Tips, every Monday and Friday. So don't forget to hit the subscribe button that's up there, or maybe it's up here on your channel. On today's episode, I've got an answer for a couple hoping to take advantage of a 1031 exchange. Here's the question they asked. What are the best strategies to minimize the tax liability on a rental sale? We bought a single-family home, lived in it for a couple of years, then rented it for the last 6 years. We'd like to sell it, but we're concerned about a hefty tax bill. We also own another house that we use as our office. Can we roll the gain from the first property to pay down the note on the office property? Here's the answer. The rental property this couple once used as a home is now considered an official investment property by the IRS because they haven't lived in it for the last 5 years. With an investment property, you can either pay the capital gains taxes owed upon the sale of the property, or you can defer them using Section 1031 of the tax code, hence the term 1031 exchange. It allows a property owner to sell that property and defer paying taxes upon the sale if and that's a big capital if the property owner sets up a tax-deferred exchange, also called a like-kind exchange or Starker exchange, Starker trust. But Section 1031 only applies if you sell a property and then buy a replacement property or replacement multiple properties with some constraints in that order. You could do a reverse 1031 where you sell first and then you buy, or buy first and then you sell. But in either words, you have to actually decide what order it's all going to happen in. Unfortunately, this couple won't be able to use the property they already own to obtain a tax-deferred exchange. If they decide to buy something new, they would. There are other constraints to consider as well. The value of the replacement property or properties must have a value equal to or greater than the property that's being sold. Plus, like-kind exchanges have strict term limits or time limits for purchasing the replacement property. You have 45 days to choose the new property or identify it, and 180 days to close from the time of sale. There are some instances where the 180-day window may shrink, but in any case, you never get to go beyond it. Upon the sale of the investment home, you'd have to set up an exchange through a company that specializes in 1031 exchanges. All proceeds from the sale of the property would then be transferred into a trust that's held by that company. So you as the owner never touch the money. Really important part of that. Just make sure that you choose a knowledgeable and reputable 1031 exchange company. There are a lot of frauds out there, and there are a lot of people, even attorneys, will do 1031 exchanges. But there have been all sorts of fraud cases over the years where even attorneys turn out to be spending the money for their own private jets. Not what you want, because again, if you blow the 180-day time limit and you can't get the money back, you will owe taxes to the IRS on any profits for the sale of the property. So not only do you not defer the profits, you then have to pay tax on the profits, and you may then still be liable to buy the property, the new property as well, and you'll have no cash with which to do it. So choose that 1031 company very, very carefully. Thanks for watching this episode of the Real Estate Minute. I'm Ilyce Glink. If you have questions about buying real estate, you should send them to me at questions@thinkglink.com. You can also send me a question via Twitter @Glink. And if you have more questions about 1031 exchanges, you should check out my ebook at thinkglinkstore.com. See you next time, everybody. Have a great week.